Joining us now is Senior North America Banks Analyst of BofA's Securities, Ebrahim Poonawala. Ebrahim, it's great to have you on. And that's exactly where I want to start with you. What does a changing of the guard at a time where investors are already eager to see deregulation in financials take place mean?
Hey Morgan, thanks for having me. So I think the announcement that you saw, I think what you're referring to is Fed Vice Chair Michael Barr stepping down from his role as the Vice Chair of Supervision. I think it's essentially the start of what we've been expecting over the last few months, that we are getting into a 15-year change in the regulatory regime for the U.S. banks, particularly the largest U.S. banks. And what this means is a more predictable regulatory environment, a more balanced regulatory environment. So you saw the announcement yesterday, and I think as we get into a period where the Trump appointees take office, be it at the OCC, FDIC, and other senior leadership positions, we'll start hearing the messaging from the Fed that should indicate things that I mentioned.
Ebrahim, let's see, the KRE, Regional Bank Index, got up as high as close to 69. Now it's back down around to 60. Rebounding loan demand, you said, should help smaller and mid-sized banks. Are those regionals the ones that investors should be thinking about there? And do you expect that to have a positive impact, rebounding loan demand on the KRE?
So, hey, John, yes. So I think there are two pieces to it, right? There's the first piece is a pickup in capital markets, M&A, IPO, so the likes of Goldman Sachs, JP Morgan, and others should benefit from that. And as we move through the year, the bigger sort of bang for your buck from a pickup in loan demand, if the Trump agenda leads to a pickup in the U.S. domestic capex, you should see a lot more of that in the regional banks that are more lending heavy.
We're already starting to see this uptick in M&A activity. There's an expectation that at some point we're going to perhaps finally see this IPO pipeline begin to burst forth and yield more activity on that front, too. How much does that matter to the banks? And if so, who's best positioned for it?
So it matters a lot, and I think if you think about the largest banks, all of them have big Wall Street capital markets presence. The pure play name, in our view, to play that is Goldman Sachs, right? You've seen the stock do extremely well, but if M&A and IPO activity show momentum as we move through the year, we don't think any other institution, large or small, better positioned than Goldman Sachs to benefit from that. On top of that, I think Goldman is at the heart of some of the regulatory relief that we expect for the sector as well. So you get a dual play between capital markets pickup as well as regulatory relief with Goldman.
How concerned should bank investors be about the degree to which working class Americans are credit stretched right now?
So I think it's a tale of two cities, right? I think inflation has hurt in an outsized way the lower income, lower credit score consumer, and that goes at the heart of whether or not inflation is under control. If inflation doesn't, so to me, the pressure on that consumer will remain. If inflation doesn't come under control or we see a resurgence, it's going to manifest itself in a higher treasury yield environment, which could be negative if we get a rate shock in the markets. But beyond that, what I would say is if the economy holds up, if the job market is strong, there's plenty of credit availability when you look at the big U.S. banks and the regional banks in terms of their willingness to sort of lean in and lend.